we are in a bear market. The only question is how long this bear market is going to last. When you just follow, for example, the global liquidity, it tends to go like up and up and up. So Bitcoin should also go up and up and up.
Bitcoin experienced a 60% drawdown. We could potentially see this next year in the midterm election cycle.
I think there's a very high chance that the Democrats are going to win. And then probably like 70,000 should be like a lower level in the sense. We were already like at 80,000, so we weren't really that far away.
I can only assume your outlook for altcoins is probably a bit worse, no? Altcoins are going to continue underperforming Bitcoin in terms of the Bitcoin dominance continuing to go up. Solana, overhyped or underpriced? Who influences crypto more today, CZ or BlackRock?
I mean, this is really...
Good morning and welcome back to another podcast episode here on the Coin Bureau. Now, today we are being joined by Markus Thielen. He is the CEO and head of research at 10x Research, a top-tier crypto research shop. So, Markus, welcome to the Coin Bureau.
Hey, Nick, great seeing you and thanks for having me.
My pleasure. Before we dive in, guys, quick disclaimer. Nothing in this episode is financial or investment advice. Please consult the disclaimer in the description for more information and consult your financial advisor before making investment decisions. Now, Markus, as I was saying before the recording, I've been following 10x for over a year now. And this year, you guys have been having some pretty remarkably accurate calls from rotational plays into and out of Bitcoin, ETH, and other alts. So let's start off right there with an open-ended question. How are you reading Bitcoin right now?
I think, unfortunately, it's pretty straightforward. I think there's no debate. We are in a bear market. The only question is how long this bear market is going to last. I think when you look at everything from technicals, from market structure, from on-chain analytics, from macro, even from the Fed. So, I mean, I'm giving you a lot of discussion points here. But whatever you look at, I think you can spin a bearish narrative, unfortunately. And I think at the end of the day, we can discuss, everybody has their own view. But if you look at the real capital inflows into Bitcoin, if they are not there, then the market cannot really go up because we need capital to push the market up. And unless this capital is coming, I think it's very difficult, for Bitcoin to even stay up here. And we have been talking since actually June that this, OG selling is kind of keeping the market in balance and it's going to really prevent the market from rallying. But what we have seen actually post the October FOMC meeting, that actually this balance turned into an imbalance because the ETFs were suddenly also selling. And that was kind of really what I think took a lot of people by surprise. But when you look historically, whenever the Fed meeting was sort of more on the hawkish side, it was really, I think, an indication that the ETFs were selling and that really pushed the markets lower. So I think there's a lot of arguments here why we're in a bear market. We have a theory, of course, how long the bear market is going to last. But I think it's just pretty straightforward. If you really follow the data and, neglect what, we all wish that the market would just go up, but it's not. And I think we can point to various data points, as I said, from on-chain to market structure to macro. And it's just, winter right now. I think we just have to really realize that.
Okay, honing in on one of those or two of those points there. So let's start on the market structure point. What exact data points should we be looking at to confirm this?
So, of course, one data point is always, retail activity. When we look at spot volumes, for example, in Korea always a very heavy, retail market. Volumes have been really low this whole cycle. There were some pumps, for example, last year in March. Then there was, another kind of October, November last year. But this year, the pumps were, a lot smaller. So there wasn't really a lot of activity in the retail market. And I think with this activity in the retail market or lack of activity, usually you see movement in the funding rate. So both are really highly correlated. And the funding rates haven't really been, massively bullish either this cycle. I think even the last couple of weeks, we really traded just a few basis points, few percentage points really up in Bitcoin. There wasn't really a lot of leverage. And I think nobody will claim really that this is like a retail leveraged cycle. It's more like a, Wall Street ETF cycle. And I think without retail, it's really difficult to see how the market is really, pushing up. And, on the other aspect, when you look at, what else is market structure is, of course, how many billions is going to being moved into stable coins, and that actually trickles then down to the crypto market. But I think we have also seen a couple of waves of stablecoin inflows, but not a lot has been, pushed down to sort of like the altcoins. And I think we see this in the Bitcoin dominance, which has, for example, sort of just been rising. I think up until a few months ago, it was one of the highest Sharpe ratio trades, I think, of the cycle. That since sort of like the end of 2022, that really the Bitcoin dominance has been rising, and as you know, Ethereum was sort of like neglected up until, the summer this year, basically. But I think it just indicates that it was first like a Bitcoin only bull market. And then altcoins have only, joined here and there, but not really for an extended period of time. So it's a very strange market, but it's a very strange bull market. But it's mainly, I think, driven really by institutional investors, and those institutional investors base their views really on, on the macro, on the Fed. And then, we are lacking really the support from the micro structure. And I think there's a lot of indicators we look at, but those ones have been kind of really like muted. And I think that's really, the unfortunate. And I think that's really the sign why those rallies for altcoins, for example, didn't really last long.
Yeah, that's all true indeed. I think that we haven't seen any retail participation, and alts have been perennially underperforming Bitcoin. But just honing in on the fact that right now we've seen this institutional interest in Bitcoin. We've seen the institutionalization of Bitcoin, ETFs, and all these big firms like Goldman, JP Morgan, Vanguard, Schwab, et cetera, that are now looking really bullish for Bitcoin in terms of offering it to their institutional clients. And then I question, well, is the argument that we need retail to extend out the bull market for Bitcoin really that, relevant in the sense that we've got now these massive institutional bids? Or what do you think is going to be driving that institutional interest in the new year, and why do you think it could be lacking?
So when we look, of course, how, when we start really, the basics for institutions, which I would say is sort of like the Bitcoin ETF flows. In 2024, the Bitcoin ETFs attracted around $33 billion, I think 33.6 billion, so almost 34 billion. This year, we are sort of like getting only 22 billion. So there's already like almost like, a third less this year than last year. And of course, the higher the market cap, the more money it actually takes to push Bitcoin up. And we can calculate this, how much money has come in. And, we have, of course, a good indication what is the multiplier of this money. When we, for example, looked at Bitcoin is a $2 trillion asset, and we have seen, a bit more than 1 trillion actually being invested in Bitcoin in terms of inflow. So we have a multiplier of around 2x really. So to push really Bitcoin up, like 50% from here, we actually need a lot of capital coming in. But I think the interesting aspect really is, I think with institutions, yes, they have deployed capital, but Bitcoin is, just marginally down year to date, versus the most money that came in to Bitcoin that we can, of course, measure from all aspects, including like, futures leverage or, again, the ETFs. It really indicates that the ETFs have sort of like really over allocated, because those $22 billion that came in actually has come in at a loss, because Bitcoin is sort of like year to date down, versus a lot of the ETFs that were bought this year, were bought, much higher. And I think that's sort of like the aspect that actually Wall Street has been, a poor allocator of that risk, unfortunately. I think we have seen this, of course, a lot through the DATs, where people bought at 2 or 3 times, the NAV. And of course, they have been underwater. So that's really challenging, right now. Versus, I think the futures market, per se. And, of course, we saw a lot of futures being unwound around the, October 10th, flash crash that we had. But the futures leverage is actually pretty neutral compared to where we started January 1st. So a lot of the leverage has been unwound and sort of like is not holding the back, basically, versus the Bitcoin ETFs. Again, bought $22 billion this year, versus, the market is down. So they are certainly at the loss here. And I think that's kind of like the difficult aspect, I think, where, how can you really push the narrative if you run a Wall Street book and multi-strategy book, and you have 10% of the Bitcoin, but Bitcoin is down. I mean, how can you get bigger risk limits for next year if Bitcoin hasn't really not performed? And of course, you can, paint the picture how this is like very, bullish because it hasn't performed yet. But I think it from a Wall Street, from a portfolio allocation perspective, it's quite difficult how, those Wall Street traders can get bigger allocations if Bitcoin hasn't performed this year. And I think that's a little bit the challenging aspect. And I agree with you. We don't really necessarily need retail. We just need somebody. But this somebody, I think it's just not there right now because the performance has not been there. And because we had so much, selling from these OG wallets. And I think the other aspect is that, of course, we have a lot more derivatives now in the market. I think that's what's really not that much reported is how open interest for options has actually increased, quite a bit and is a big driver of the market. And I think a lot of the options that are being traded is really called selling. And of course, called selling means somebody is capping the price. And of course, it also means that somebody is not going as long delta as you would expect, because usually people buy the ETF and they sell options against it and they harvest sort of like the option premium. And I think this is why we have seen volatility come down over the last 2 years quite sharply. So since the ETFs were launched, because there's a lot of people suddenly that are looking at, extracting yield really from Bitcoin and not necessarily looking at the open-ended upside that we, I guess you and me, we looked at last cycle and the cycle before, versus now it's more people, okay, how can we capture the yield that's available in the market? And because Bitcoin implied volatility trades at, 40, 50, 60%, versus S&P only trades at 20%. And people look at, how to harvest this volatility, especially Bitcoin really hasn't moved that much this year. It hasn't really been that volatile. So
yeah, there's many points I want to hone in on there for sure. I mean, for one, the option writing. I believe I was listening to a podcast with Matt Hogan from Bitwise, and he said that a lot of these OG sellers, instead of just selling a spot, they basically also write in covered calls to earn yield on their Bitcoin to not realize the gain. So that's also, having a suppressing the price and that impact. And then also, I tend to agree with you from the perspective of factor investing. If you think about how large institutional asset allocators think about allocating to asset classes in the new year, momentum is a big factor. And if you have a lot of these other asset classes that have performed on the year and then Bitcoin hasn't, it's kind of like doesn't lend itself well to that thesis. But one of the big arguments that's been made now by a lot of people in the macro side of it who analyze crypto as well is this concept of global liquidity coming in next year. And they point to a few factors. Like one is, we've had a rate cut yesterday. We've had the QT ending. I believe the Fed in the FOMC also mentioned they're going to limited bond buying, which is, of course, limited QE. And then there's also talk of this banking reserve ratio, which will be decreased, and that could be liquidity positive, and then potentially a dovish Fed with Trump's appointee. So this argument of global liquidity going into the markets is going to help lift all risk assets, including those down the risk curve like Bitcoin. What do you say to that argument?
So the, global liquidity is, of course, I think, a big driver, but I think it's very important to figure actually out what global liquidity is and when it really comes. I think when we look at, some of the misconception that we have, people look at, the money supply, the M2, and claim this is really like a big driver. And of course, intuitively, it makes sense. The more liquidity there is, so the higher Bitcoin and other risk assets really should rise. But when you actually look at the correlation with Bitcoin and let's say M2 over 15 years, it actually shows you that there is actually kind of like really like a cyclical movement. So every 2 years, the correlation is very high, and then it breaks down. Some people, of course, have adjusted this time series and moved it forward by 13 weeks. I think nobody can really explain why it should be 13 weeks. It's not that it takes, 13 weeks to carry it from, Washington, D.C. to some exchange, in the Far East to bring it, the liquidity there and then suddenly moves, or that it takes so long to the pipes and everything. It just fits. But I think, our view during the summer was that this actually is about to break down because it's sort of like, the timing that it would break down. And I think with the other aspect that people make a mistake here is they look at it as a linear relationship versus it's a power relationship. So the power regression. So which means basically if liquidity goes from, 40 trillion to 90 trillion, it has really like a multiplier effect. But if it reaches a 90 trillion and we are around like 105, 110 trillion, but if it reaches above 90 trillion, Bitcoin can go literally anywhere from 30,000 to almost infinity because it's a power regression and not a linear regression. So I think the question is also how much of this really money supply feeds into the crypto market. And I think the one point we pointed out earlier this year was actually that the change in global liquidity this year was quite big impact was actually driven by the weakness of the US dollar, because it's liquidity from 29 central banks denominated in US dollars. But of course, if the ECB, pumps liquidity in the market, it's in euros. And if, of course, the euro gets stronger, it actually looks really that liquidity gets strong. But if it's really, just a US dollar devaluation, then it's not really a lot of net liquidity in the market. And I think that's why we were, quite hesitant to really sort of like embrace this metric. And we look more kind of like, some real Bitcoin metrics, how much money is really moving into Bitcoin. We look, of course, stable coins or some other real, data points. And I think the other aspect is, of course, people pointing to the, Treasury General account. But here also, of course, it has been refilled from, 300 billion to 900 billion. And any moment, I think people were initially expecting, as soon as the government in the US reopens after the shutdown, that is going to be depleted. And suddenly, there's all this liquidity that's going to, pump Bitcoin up. But I think we had this similar aspect in February this year, where it actually took 2 months to really, deplete, really just release all the liquidity from the, Treasury General account. And it really took from February until April, until really, it was, I think, also from like 800 billion to around 250, 300 billion. So there was suddenly liquidity coming in. But if you remember, during this time, actually, Bitcoin fell. So despite the liquidity from the TGA coming into the market, Bitcoin fell, and Bitcoin only started to rise after the whole Trump tariff tantrum, basically. So that's also like an aspect. And I think I would actually argue that, the additional aspect here that, yes, the Fed cut, but the Fed cut for the third time, and the last 2 times in 2019 and in 2024, when the Fed cut for the third time, they actually paused. And in both instances, Bitcoin fell, I think, 7% and something like 20% over a period of 30 days post the meeting. So in both of those cases, we rallied into the meeting and then we sold off. And I think that's quite a high chance that we're going to see this again now, for the simple fact is that I think the statement itself was hawkish. I think Powell started to talk sort of like hawkish or try to talk balance. And the longer he talked, the more dovish he became. He indicated, of course, that the employment data was overstated and the, other aspects, of course. But I think the market actually would look through it, because the market, I think, realizes or knows that this was probably just like Powell's comments or interpretation, versus the committee has clearly indicated, based on the statement, based on the dots, that they only expect 1 cut next year and, another cut, the year after. So there's only really 2 more cuts priced in over the next 2 years, which is not really, as dovish as people hope or as dovish as people expect. And I think that's why it's kind of really difficult to expect a lot of, tailwind from the monetary side, because we need to wait, for the data that's going to come probably next week, the employment data, and more data is going to come in January. But I think Powell has also indicated that, I think that's how he started the press conference, that the interest rates are sort of like at the neutral level now, where they feel very comfortable. So it indicates actually that there's going to be a longer term pause. And if you recall, last year in September, the Fed cut by 50 basis points and we had this monster rally into the Trump election. But then by December last year, the Fed also cut for the third time. Powell actually talked more hawkishly. Powell suddenly indicated, of course, with Trump's election, that there's going to be tariffs and the inflation is going to be avoided. And of course, that's sort of when we peaked out. Of course, we bumped around it a little bit until the Trump inauguration on January 20th. But then we quickly sold off because there were no rate cuts coming. And we had to wait again until this year, September. And of course, we have a very similar playbook now, where when are the next rate cuts? When is the next liquidity injection? I don't think there is going to be a lot of liquidity injection right now. But my biggest worry is, of course, that the unemployment rate is above the 12 months moving average. And every time this has happened in the past, and it only happened now the 4th time in the last 30 years, so it doesn't really happen that often. But usually you will get a recession down the line. And I think the question really is, at one point, do we accelerate in that level, in that unemployment rate? And if it does, I think it's a little bit worrying also for risk asset. And of course, stimulus will come, but usually there's first some more pain. So that's how we look at it from a macro perspective.
Wow, there's a lot there to to focus on. Okay, I'd like to take a moment to thank the sponsors who make this show possible. SVM's ecosystem has been missing a high-speed, low-latency chain until now. Fogo delivers 40 millisecond block times, 1.3 second finality, and near zero fees, all backed by high-performance validators co-located near major exchange infrastructure. Made for traders, by traders, zero compromise. It's not theoretical, it's live and blazing fast and ready for you to test. Head to fogo.io/start and experience the future of trading. A few of those. I mean, obviously, yes, it's a good point that there's only one rate cut priced in terms of the dot plot for next year, and 2 over 2 years. So that's true in terms of like the impact on liquidity there. And then I'm curious though. So you say unemployment should be a concern now, whereas a lot of the Fed officials seem to have a concern around on the inflation side. Do you not think that they would, if you point to the fact that they should be concerned about unemployment, they should be more dovish and be more accommodative to rate cuts next year than now, where they're kind of a bit more hawkish?
So, of course, I think the main question really is, what do rate cuts really, do for the labor market? And I think, we have seen, now I think 175 basis point cuts, over the last, I think 18 months, 2 years. And it hasn't really done much for the US housing market, for example. So, the question is, before, meaning, I guess, 20, 30 years ago, when there was a lot more, as I call it, fixed capital investment. So, of course, you build a factory because you have to employ all these people. A bank loan with lower interest rates was really helpful. But I think these days, there's not a lot of, fixed capital investment. So you don't need to buy the land. You don't need to buy or build a factory. You don't need to, have all this massive capital expenditure where interest rates really, matter, in that sense. So I think these days, start companies relatively easily. And so interest rates maybe doesn't really make such a big difference. And I think there was also, this concept, of course, that interest rates take 18 months lag until you really see them in the economy, because again, it took so long time until you built a factory, you set it all up, and it just took a long time. But these days, the transmission mechanism is actually probably a lot faster, less clean. And I think the question really is, it's more probably, I would argue, on the forward guidance, what actually the central bank chief really communicates. We have seen this with Draghi, we have seen this with Yellen before. And it's not maybe the actual level of interest rates that really matters, because, does it really matter for Nvidia? Does it really matter for, Microsoft or Facebook, where interest rates are? I mean, they can, they have a different borrowing rates anyways. It's more the stories that they can spin. It's more the narrative that they can tell to attract investor capital. So it's not really that actually people really need, I think, a lot of the money, because, all these tech companies have the money, and they're really the ones who are really driving this whole, CapEx expansion really. And it's not really financed through debt. It's more, financed, through the free cash flow up until, I think, of course, recently when they started to build more of these data centers. But I think even those investments are not really dependent on interest rate cuts. So that's why I think it's very difficult, to pinpoint. And it's probably, if we get into this scenario that suddenly there's not a lot of hiring because people becoming more cautious, or using, more AI, and, not really willing to train a lot of junior people. I mean, that's the stories we hear from, from US banks, that the hiring, is down. So the question really is, I mean, what can the Fed really do in that scenario? And I think it's maybe, yes, I mean, they can cut interest rates, but the question really is, how low can they cut interest rates, right? I mean, when, as you acknowledged, inflation is at 3% and it's quite sticky there, and it should be lower. And of course, Powell, kind of tried to hide behind the argument that yes, it's, it's all tariff driven and it's transition here. But when you think how, can interest rates in the US really be below the inflation rate, right? So inflation right now is at 3% and interest rates are at, 3.75 around. So, how many cuts can we have, right? So if inflation might be sticky here at 3% and 2 cuts are priced in, I mean, then we are almost at 3% already. So it's not that we have a massive tailwind. And I think the biggest tailwind for risk assets is really when we're having this, change in inflation expectations. For example, we came out actually with a really bullish report in end of October 2022, literally like a week before FTX blew up. And it was built on the argument that based on our models, inflation in the US should fall from back then from 8% to 3% in a year's time. And of course, Wall Street, basically all the Wall Street economists for 2023 expected a recession because of the permanently high inflation rate as people expected. But of course, inflation came lower. We had this big bull market, and that was really like an inflection point. But I think here the question really is, I mean, where's the inflection point if we're cutting in twice next year or once or three times? It's not, at the margin, it doesn't really make a much difference. And I think that's really the problem with risk assets. They really need this big shift where it's going from bearish to bullish, from hawkish to dovish, versus right now we're going, it's kind of like the stop and go. And I think that's why we had this Bitcoin run this cycle is a stop and go cycle because, the Fed cut 3 times and they didn't do anything for 6 months, and they cut for 3 times and then maybe don't do anything for 6 months. So it's very difficult, I think, for Bitcoin itself to find its footing because there's not a natural buyer in the market for equities. Equities have all these insurance funds, pension funds that are always buying versus Bitcoin. Bitcoin depends more on those macro factors, but the macro factor is not a massive tailwind. So that's kind of like how I look at it. But I think there is an aspect that the inflation rate is sort of like on the back burner. And I think, people can do much about it. Usually, maybe the tariffs, kind of like work itself out. But I think the other aspect really is that the employment rate historically, once we have started to ramp up in the unemployment rate, that it actually has really, spiked a little bit out of control until there was a recession. And I think if you just look at a chart from, 20, 30 years history, I think it indicates we are sort of like at this, bottoming period right now. And as long as we are above the 1 year moving average, I think it's sort of like quite a negative sign. And yes, there will be more stimulus if this goes a little bit out of control, but it will also come with pain in terms of risk assets first.
Yeah, you made some very good points there, especially as it relates to inflation expectations. I mean, if you look at where 10-year rates, longer term rates are trading, the markets are worried about that. And that longer term rates obviously impact more on the real economy than just the shorter end. So that could also be a drag. I just want to quickly hone in again on the liquidity argument, because as a researcher, you have many different proprietary indicators, and I'm sure you gather information from lots of other data sources. For a crypto investor, and taken from the perspective of trying to ascertain how much liquidity is going to impact on price of crypto, do you like to look at these larger, bigger macro data points like, the TGA or M2, all that stuff? Or do you prefer to hone in more on crypto native liquidity like the stablecoin supply, as you mentioned?
I think crypto native liquidity, is a lot more relevant for the crypto market. I think the other aspect is really sort of like hypothetical. People like to look at, for example, like M2 before, but, they confused, money supply, with real liquidity hitting the crypto market. And I think, when we look at, on-chain data, how much money really goes into Bitcoin, I think that's a lot more relevant. And I think that's kind of the data point we actually feel most comfortable with, because I think the other aspect is sort of like, I think it's almost like, a misconception, right? I mean, you mentioned before that also, the $40 billion that the Fed is going to start buying now in short-term bills. But, to be really QE, it needs to be longer-term treasuries, right? It needs to be 10 years plus to keep really the longer bond yields anchored, because a lot of, let's say, corporates, if they make interest rate decisions, it's really on the longer terms, right? It's not really on the short-term borrowing that really matters, because the short-term is already very low, right? The 2 year is at 3.6. So if the Fed buys more of those or even shorter, it's not going to really, I think, move the liquidity needle. It's really more the longer term things. But I think it's interesting when you look at a year ago in December, on a 30-day window, there was $100 billion was moved into crypto. This was around, of course, post the Trump election. This summer, we have seen around $60 billion. This is, of course, around the Genius Act. There was, of course, a lot of, hype, of course, with the Circle IPO and a lot of positive momentum, a lot of stablecoin issuance also. And that was like 60 billion, as I said. But right now, the last 30 days, we have seen 4 billion. So we're coming from 100 billion being moved into Bitcoin a year ago to 60 billion during the summer. And now we only have 4 billion. So I think we can easily explain by those flows, by real flows, that are literally, we can of course detect how much money goes into Bitcoin and out of Bitcoin, but we can easily explain why we are here and not higher. Versus when you just follow, for example, the global liquidity, it tends to go like up and up and up. So Bitcoin should also go up and up and up. And I think it has really failed to explain, once Bitcoin has reached this, call it, escape velocity above like 90 trillion. And above 90 trillion, as I was saying, it's more kind of like a power regression where, we can be like literally anywhere. We can explain any level, from 30,000 per BTC to literally, 500,000 or a million, because there's no kind of, it's escape velocity really, right? It's almost like, flying into orbit. But I think what really matters for Bitcoin is the actual money that's being moved in and out. And I think we have shown, for example, that also the Bitcoin ETFs, they really depend on sort of like a dovish guidance. So it's not just the cut itself, is that beyond the cut, there also needs to be the prospect of probably another cut. And only then the Bitcoin ETF flows come. I think one of the most, people of course look at the ETF flows day by day, but I think the most interesting aspect is when you aggregate them and look at them really based on a lot of these central bank meetings. Since the October 29th FOMC meeting, Bitcoin ETFs have seen around $4.5 billion of outflows versus, year to date, we have seen $22 billion of inflows. So it's almost like, once Powell shifted to a more hawkish tone at the October meeting, the Wall Street investors have started to sell. And I think that's why, yes, it's all very positive if the Vanguards of the world and, the Morgan Stanleys and so on, they can all buy now, or their clients can buy. But what we have seen with the real flows on the ETF side is actually Wall Street investors have been selling since the October FOMC meeting. And this is why Bitcoin actually sold off. It didn't sell off because of the, October 10th crash. It didn't sell off because of, something else. It sold off because of, the hawkish FOMC meeting. And that kind of kept Wall Street investors away. And Wall Street investors were the ones that were buying from the OGs. And there was this balance going on as long as you had both parties, sort of like matching off each other's flows. But then suddenly these ETFs also turned sellers. And I think that's why we sold off from, 120,000 to sort of like 90,000. And we really struggle to kind of rebound here because ETFs are still not buying. Sorry, I wish I had better news.
Yeah, I mean, my hopes and dreams are fading away. Okay, so 2026, another thing, obviously, in 2026, apart from all the other factors you mentioned, is it's an election year. And in a recent CoinDesk interview, you warned that in previous cycles of Bitcoin or previous election years, Bitcoin experienced a 60% drawdown. We could potentially see this next year in the midterm election cycle. Do you think that's possible? 60% down next year?
So, I mean, we sort of like are around already like 30% down, we can argue. But I think what's interesting is, of course, we have, used the halving cycle. We have, of course, used, all these models from stock to flow to liquidity and try to understand what really works. And I think there is really this concept. And this is why, again, we had this, CoinDesk, actually, since you mentioned CoinDesk, but they wrote this story, on October 28th, 2022, when we came out with a really bullish estimate, and it was midst of the bear market. Nobody wanted to hear it, right? Everybody was really depressed. But it indicated that 15 months before the halving, it's usually the time where Bitcoin bottoms. And of course, there's not many data points around the halving, so it's very difficult to make really statistical, reliable indicator here. But I think the aspect is that actually is more relevant is sort of like the US midterm elections. And the US midterm elections is every 4 years in November, and almost by clockwork, around 12 months before, Bitcoin tends to peak out. When you look at, the peaks of, the bear markets we had, of course, was in 2014, 2018, and 2022. And, these are all, of course, US midterm election years. But the peaks were, of course, always the year before, but the peaks were always between October to December, primarily actually in December. And of course, the peak, for example, in December 2017, it was sort of like a mixture between the CME Bitcoin, launch, but there was also some regulatory enforcement action then that sort of like peaked the bull market. The bull market in 2013 peaked also in December. It was sort of like also driven by some regulatory action in China and everything. And it's, and of course we know that the bull market in 2021 peaked in sort of like November because people expected the Fed to turn hawkish at the December meeting. So it's always like this sort of like end of the year kind of scenario, which is sort of like where we are now, or where we have been, since October, since we peaked there. So it falls into this scenario. And what we have is actually between January to October of these, US midterm election years, is that the US stock market tends to go sideways. So there's a clear indication, the 4 presidential years, how the stock market performs. And the worst year is always the midterm election year, because that's usually when the sitting president loses a lot of votes, or his party loses a lot of votes in the House of Representatives. And then, of course, he becomes sort of like a lame duck, because usually the other party wins. And I think there's a very high chance that the Democrats are going to win. And then a lot of, the Trump's expansionary policies might not be pushed through. And I think that's kind of like the argument why sort of the stock market might be running out of, steam here as well, and sort of like go sideways. There might be some sector rotation. And I do fear there might be this worry then for Bitcoin as well, that, Trump was, of course, the Bitcoin president, but what if he cannot do his policies anymore? Maybe there will be nothing is going to happen really. And I think that's kind of like the risk where that sort of like we are sort of like foreseeing, because when you look at historically, during those years, Bitcoin actually had a sharp correction. Can it go down really 60%? I think, I would say probably like 70,000 should be like a lower level in the sense, because there's some super technical support there. And so we haven't been, we were already like at 80,000, so we weren't really that far away. But it's very difficult to identify what's really going to push Bitcoin up from here. Our scenario is more that we just trade around this sort of 80,000 to 100,000, for a while, but we fail to really break out. And I think there is a drift lower because of that.
Okay, well, I mean, that's if it seems like a bit of a bearish outlook for Bitcoin or for the next few months. I can only assume your outlook for altcoins is probably a bit worse, no?
Well, yeah, I mean, altcoins, we have actually been since the beginning of the year suggested to people to hedge Bitcoin with an, diversified altcoin portfolio, because it's difficult to argue why altcoins should rally. And I think the argument is really that we have around $59 billion per year in unlocks. And a lot of those unlocks are, VCs, early investors. But I think the focus is really on the VC side, or on the hedge fund side here, where a lot of the investors that, again, invested in the VC funds in the last cycle or even the cycle before probably want their money back, because a lot of those, VC investments sort of failed to list on, on the IPO market. We didn't really have a lot of IPOs coming, this year. Of course, we had Circle. Of course, we had, Gemini, we had Bullish. But I think there's a lot money trapped, really, I think, unfortunately, from these LPs, and the LPs want their money back. So I think there is this constant pressure of, selling some of those holdings. And again, it's like $59 billion per year. So there is a natural seller in the market. It's almost like the opposite of the US stock market, where there is always a natural buyer. And I think that's a little bit kind of the tricky part, how to argue. But I think the thing that's, I think, a little bit, the really unfortunate thing is that there is not a lot of real narratives and not a lot of stories, right? I mean, this RWA, how can you really make money of holding the token, right? I mean, even the Lido token really passes on not a lot of, of the revenue that they're generating. I mean, when you remember, like last cycle, it was all exciting. It was all DeFi. It was, last time there was so much to learn almost, versus now it's just to learn where the capital is flowing, but there's not a lot of, I think, exciting protocols. And I think that's a little bit the unfortunate, time. And I think that's kind of like where I would argue that, not a lot of money is actually being used to really deployed in DeFi. So it's, the narratives have really changed. And, last cycle was also a lot of minting, on the NFT side. So you needed to buy Ethereum, versus now it's more kind of like, well, I can make 3% staking yield. I mean, after all the costs and everything, it's a lot less, versus the 10-year treasury pays around, 4.1, 4.2. So there's actually a negative carry to move money from TradFi into crypto, versus last cycle, thanks to, Three Arrows and Alameda, who were paying, of course, massive, yields basically that could be passed on to various instances, versus, treasury yield were just like 1%. So there was a clear incentive to move money from TradFi into crypto. just to harvest the higher yield, versus now it's the opposite. I think that's why it's very difficult, because if the more and more yield is being ETH is being staked, for example, I think the less and less will really be used, unless of course it's liquid staking. But I think a lot of the ETH that are being staked is just like laying around and not being used. And I think that it's a sign, where we are in the cycle. So I would say we need more exciting protocols, exciting stories, exciting narratives. But I think the VC investors have not really put a lot of money into crypto. And that's why a lot of protocols didn't really have a lot of, marketing budget to drive like great narratives or something.
Interesting. So do you think the narratives are the catalyst which could take alts higher? Right now, there's just nothing that's compelling from your angle in terms of what's come out this cycle.
Well, I think when you look historically, right, people always try to look at the halving cycle as sort of like why we rally. But I think in the end, it was always like an exciting story or a new way to acquire Bitcoin. It was something else was really going on. It was not suddenly that the mining rewards were cut, in half, that suddenly Bitcoin would be rallying. It was, for example, in 2013, it was suddenly, Bitcoin was available in China. China discovered it. Baidu, which is like the Chinese Google, was accepting, Bitcoin payments for some of their services. That's really when Bitcoin went up 10x in a matter of weeks. So there was like a great, story really around, right? And I think really like a sort of like a use case, versus this cycle. It's more about buying and storing the asset, but not really using it. And I think that's really kind of like where the narrative runs a little bit, foul, because we don't want people to just sort of like just stake their ETH. We want the people using their ETH for something exciting. We want, people using ETH to, mint NFTs or something else, right? But using it. And I think that's really the problem we have is that historically, when there was, when the cost structure went lower, for example, when batteries for cars, when the cost for batteries went lower and lower and lower, suddenly, of course, Tesla exploded because it was cheaper for them, to buy these batteries and put them in their cars and everything. So there was a lot more, volume going on, versus I think right now is, of course, we're having these finally Ethereum, fees, gas fees are lower and lower, but not a lot of volumes is happening. And I think that's sort of like the mismatch, right? Historically, you might know this as well, right? But, used to be quite expensive to download anything on your phone, right? Because, the servicing fees were so high, you couldn't, even download the picture. But now it's sort of like so cheap that, it doesn't really matter. The cost doesn't matter. So the volume is exploding, how everybody's using, the data services, for example. But we don't see this in crypto yet, despite the low gas fees. So I think something needs to happen there. And when this happens, I think then we have a new narrative, then we have a new bull market. A new bull market will come for sure. The question really is, when, and, I don't think we can rely too much on macro on that side.
Got it. So just in terms of next year, you think that altcoins are going to continue underperforming Bitcoin in terms of Bitcoin dominance continue to go up?
Yeah, I think so. I don't think there's a real compelling story for altcoins. I think selectively, for example, like I think BNB is probably one of my favorites, simply because you can generate some higher yield. You can participate on the launch pads. You can participate on some of the token launches there. And historically, this year you would have made another 10% in terms of yield. And I think it grows with the ecosystem. I think we have shown in some of our analysis that, the BNP actually grows with a number of wallets in the ecosystem. But I think a lot of the other projects, a lot of the protocols that we like last cycle, they sort of have become like, dead ends. And I think when you look at a 10-year chart or 6-7 year chart, some of them look really depressing, in terms of like the waves, but they always need a new narrative. And I think with the new narrative, then more crypto sort of like investors come. And, there was, when we started the conversation and when we talked about, Korean retail investors, they need to get excited. So retail money needs to come in to really push prices up, because Wall Street money cannot buy the altcoins, right? I mean, that's why we really need, the retail investors. And I think that's sort of like where the narrative needs to be, aligned. But, so far we're not seeing that.
Yeah, makes sense. That narrative is what drives retail. So Markus, just to finish off here quickly, got rapid fire questions, one answer, that's all, and then we're done. Firstly, Solana, overhyped or underpriced?
Overhyped.
Okay.
Sorry.
Second one, if you could use only one chart forever, price, flows, or macro to influence your decisions, what would it be?
It would be the 21-week moving average for Bitcoin.
Okay, perfect. 21-week moving average. And finally, and this kind of relates to your writings as well in terms of the control of crypto. Who influences crypto more today, CZ or BlackRock?
Excellent question. I mean, this is really BlackRock. And I think if I may, take this question here.
Yeah, sure. Go ahead.
When you look back at this is really like a very, very important question. When you look back, each cycle had different promoters. Each cycle had different people, to bring into the crypto market. You probably remember like Bitcoin Jesus, right? It has all changed. Of course, now it's more Larry Fink or, Tom Lee, for example, who is of course on, CNBC every day or 3 times a day. So I think it brings in different people. And I think even like last cycle, we had a lot of more retail proxies, right? People that were close to the retail market, versus this cycle, these are all institutional players. There's nobody, we haven't really heard much from, Vitalik. We haven't really heard much from CZ, I would say. I mean, CZ seems to tweet, every couple of weeks, some, keep, hodling or something. But I think this cycle, it's really institutions. And I think that's why these Wall Street players, these Wall Street promoters are the ones who are really most influential. But I think to bring up the retail market, we need those people that really resonates with the retail people, right? We need somebody young, dynamic, somebody crazy. And I think we're missing really the crazy people this cycle. And I think that's why we're not bringing in the new retail crazy people. And I think that's what we need.
Totally agree. We need more Vitalik tweeting, CZ tweeting, and less of Larry Fink singing about the, tokenized assets. Well, thanks a lot, Markus. I really gained a lot from this. This was super insightful, albeit relatively short, but there were so many more questions I could have asked, but you're a busy man. I'll leave a link to your Twitter and your 10x research website below for our viewers. Where else can people follow you and get your insights?
10xresearch.com. We on Twitter, as you said, we publish frequently, happy to, help out everybody who needs some help. And we are there to, provide our honest views about the market because we want to make some money. Of course, no investment advice, but we want to kind of look the market from what really drives the market. And that's kind of like what we, project in our research reports.
Yeah, not financial advice, but following 10x, subscribing to 10x as well, worth your while. Thanks a lot, Markus. Really appreciate it. Have a great day, guys.